Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Stocks bouncing back as President Donald Trump tempers his trade stance on China. Seema Shah of Principal Asset Management writing the following. Even after the strong performance of the past 6 months, with the S&P 500 up 35% from its Liberation Day trough, equity markets have further room to run. Seema joins us now for more. Seema, welcome to the programme. Will you get a helping hand from earnings season and from bank earnings this week?
Hey, John. Yeah, I think that is definitely on the cards. You know, when we're looking across at the macro outlook, we're still feeling pretty positive. Of course, there are some signs of slowdown within the labour market, but we're not talking about recessionary area. And typically in this kind of environment, we can see continued performance from financials. So along with those tech stocks, which continue to drive the market, we would think that financials can join in with that rally and help push the equity market a little bit further.
Seema, it's not just bank earnings on the calendar, also a meeting potentially between the two leaders from China, from the US, President Trump and Leader Xi. Seema, how big a factor will that be in your outlook? The trade negotiations, the friction, the tension between China and the United States?
Yeah, it's a great question because, you know, in the last couple of weeks, it's completely fallen out of the headlines. You know, nobody really talking about the risk associated with it. So the news on Friday, I think, did come as clearly did jolt the market. It has the potential to have very, very serious impact on the economy, both from a growth side and from an inflation side. So we obviously have to keep a close eye on that. At the moment, from our perspective, we're going to go along the assumption that things eventually kind of work themselves out simply because the risk is so big. But it does clearly have the potential. And so investors, and I think the key thing is that there has been so much complacency within the market about what could happen to how much further the equity market could run, that this has been a good reminder that there are still risks on the horizon.
Risks of re-escalation between the U.S. and China. How much does it also reiterate the risk that this is not just a one-time price shock, but it's an ongoing process of tariffs that come on in different waves and price effects that happen over time, kind of like what we saw from Levi's last week?
Yeah, and, you know, Elisa, I mean, I think this is one of the things that we've been considering is that from the tariff perspective, this is an ongoing story. We know that tariffs are going to be used continuously as a geopolitical tool and for any other kind of negotiations that the US is looking to do. We're also expecting, even before Friday, that tariffs would continue to move a little bit higher. They'd change in focus sectors, more company focus. So I think this is still inbuilt. But we have seen time and time again that from a market perspective, these kind of headlines, they do start to move back and back and back in people's mindsets, especially as companies do start to kind of navigate their way through. So it's not to say that there won't be any impact. There will be. It is contributing to an economic slowdown, but we're not looking at something which is recession-like, provided the US-China negotiations do move in the right direction over the coming weeks.
So if there isn't really that great of a chance of recession, which is what I'm hearing from you, do you buy any dip? Was what we saw on Friday something that you want to welcome, usher in, and dive into?
I do think, I think any kind of noise, either with regards to the shutdown or even with the trade tensions, these are opportunities because we're trying to look beyond the noise. And, you know, this has been a really good learning for this year, is that back in April, when everyone was really worried about recession, they were worried about how there was going to be a very significant market correction. We are up very, very significantly from those moments, and the market has managed to look through. So we would assume that this is going to be a continuation. Valuations are that much higher. The economic backdrop is a little bit slower. So, you know, we're not going to be expecting to see gains as significant as we've had in the last couple of months. But to our minds, this is still a positive setup for equities.
The issue, though, with what's going on with trade is that J.D. Vance is talking about the fact that it's up to Beijing to choose the path of reason. Does it not feel different this time than it did in the spring?
There are definitely differences, and I think the key thing is that China is showing that it has a lot of power in this. It's got a very, very strong negotiating tool. So it's very much sitting in, I guess, in their area. And what is the US going to do to kind of bring down the tensions? So there is a difference, but I think at the end of the day, because the impact could be so serious, it's almost that too big to fail situation, which we would assume is going to push both sides to some kind of negotiation point. It doesn't necessarily mean that we're going to be looking at lower tariffs. We could be even looking at slightly higher tariffs than where they are today, but we wouldn't expect there to be a move back to the 135% tariffs that we did see earlier this year.
Do you think this just gets done by November 1st, where the president said that seems like an eternity for him, or is this a 2026 story for the market?
I think we can get somewhere by November the 1st. And I have to say, I think it's going to be a very, very rocky road with a lot of noise, a lot of back and forth. But certainly, I think that the issues with China is not something which can be put to bed very quickly. I would assume that this is going to be a situation that we're going to be talking about through 2026, through 2027. And that rivalry between the two countries is going to be something which is a continued pain point, which comes back to rock the market every now and then over the foreseeable future.
What was interesting, and John pointed this out earlier, is that on Friday we saw a rally into U.S. Treasuries. And this was different than what we saw after the April 2nd Liberation Day. And it raises the question about whether the market is looking through any kind of price shocks as one-time, transitory, or whether it's complacent about the inflationary ramifications of this decoupling between the U.S. and China over a longer period of time. How do you see that?
Yeah, it's an interesting one because, in the last couple of months, you haven't really seen the inflation impact that people were anticipating in April. And so I think that what we saw on Friday was just this assumption that, this is the continuation. There will only be a one-time shock. It'll be very modest. This is really, really early days. So to our minds, one of the key risks that we do need to look out for in 2026 is, the inflation numbers moving a little bit higher than anticipated. At the moment, we're expecting CPI to be hovering around the kind of the mid, or I should say the 3.2 to 3.3% level. If we were to see it move above the 3.5% towards a 4% number, well, then I think the equations kind of change. And I think that would be a real sticking point for the market. But it is really early days. And I think as we go into earnings season, that to us is going to be the key thing that we're listening out for. What are CEOs telling us about the price impact, how much they're planning to be passing on? And I think that picture won't be very clear until we're looking into Q1 or Q2 of next year.
Stay with us. More Bloomberg surveillance coming up after this. Let's turn to the US dollar. The index down 8% year to date, facing ongoing volatility. Jean Boivin, head of the BlackRock Investment Institute, writes, "We see the US dollar slide tied to expected Fed rate cuts and fiscal concerns, not evidence its reserve status is under threat." Jean joins us now for more. Jean, good morning.
Good morning.
How difficult are people finding it to draw a distinction between one and the other?
Yeah, I think, if you look at this year and the commentaries around the dollar and so on, and connect the dots between, uncertainty on policy and so on, it's easy to tell a story that investors are more skittish about the dollar, and it's a specific dollar kind of risk premium that is being applied. But, when you look under the hood and the facts so far this year, there's no massive disconnect between the dollar weakness we've seen and historical fundamentals behavior. And so on the face of it, there might be down the road question about the reserve currency status, but I don't think we have the evidence for it yet. I think, moreover, when you look since all the discussion about central bank independence and so on, heated up over the summer and a bit before, the dollar didn't really weaken against other kind of G10 currencies. So we think it's more of a broader fiscal story globally. You see a yield curve steepening, and that has some impact on gold versus currencies. But I don't think we see really a U.S. dollar kind of reserve currency trade yet.
I'm glad that you brought up gold, because the dollar has depreciated dramatically against gold. And you could argue that the only reason why you haven't seen a greater weakening in the dollar is because nobody else is much better. How much is this absolutely debasement, but represented in gold? Not necessarily anything specific about the dollar as reserve status, but just generally a change in the global financial system.
Yeah, I think there's more to that, I think, going on right now, which is how we will resolve these fiscal outlook globally. We see what's happening in France. We see Japan, the U.S. So I think it's a common story. The gold is attractive in that context. I'm not sure, if it's going to be a long-term trade, but clearly when the markets is a bit more anxious about these questions, we see a narrative that bids gold up. It's been playing up. It hasn't worked for a long time, but it's been working this year for sure.
You talked about a yield curve steepening, and the more we talk about this, the more I question why we're not seeing an even steeper yield curve, why we're not seeing even more of a sell-off in long bonds globally in developed markets, given some of the fiscal concerns and given, frankly, this debasement that we've been talking about. Does that strike you as odd?
I think we might be getting lucky at this juncture, where the U.S. economy might be weakening just enough so that this doesn't really come to head just right now. We were a bit more concerned coming into September that you would see, inflation maybe not behaving. Last time I was here, I was talking about like the doubts we had about the ability of the Fed to cut as much as the market was expecting. Now we are a bit more confident that the Fed can deliver. The macro is weakening enough, and that's going to help relieve some of the debt servicing cost tension that were happening. So we might be for the next few months, or I don't know for how long, in a more of a lucky spot where these concerns are not really coming to head. But underneath that, I totally agree that there's a bit of a disconnect, and that's why we think longer term we'll need to see long-term rates go up from here, and a 10-year closer to 5 makes more sense for us than 4%, a few years down the road.
John, when you say there's no evidence right now that the dollar's reserve currency status is under threat, what would you see if it was? What would be happening?
I think you would. So you look at this year, more than 50% of the weakening that we've seen can be attributed to the increased easing expectation from the Fed. So just the interest rate differential story that we've seen this year playing out explains a big part of the move. And then, the yield curve steepening, investors asking more for a term premium for, holding debt, U.S. debt, maybe that has played some role as well. But the point is that if you look at how the dollars behave relative to term premium, the VIX, or interest rate differential historically, that relationship hasn't really broken. If we were seeing that relationship break and the dollar being much weaker than these fundamentals suggest, then I think that would start to be evidence that the investors are asking for more than just the fundamentals, and they're more worried about the dollar.
What signal do you take from the relationship between gold and risk more generally? The equity market move paired with the gold move this year?
Yeah, I think there's a story around some concern of fiscal dominance maybe playing out down the road. Not a reality, but markets are paying some credence to that. But at the same time, before you get there, you have an environment that's going to be pretty supportive for equities. So I don't think there's really a disconnect. It's an easy financial condition world, maintain for longer bids, equities, but you want to get some insurance with gold.
Do you think we are on the path towards fiscal dominance in 26?
I think this is a huge call, and one thing that I keep saying is in 2025, one thing that we need to guard against is extrapolate from what looks very dramatic in the near term to long-term consequences and big change, right? So on a day you see some headlines, you can be tempted to see, I never would have expected to see a headline like this, so hence we're going to see fiscal dominance. At the same time, I think these are big steps. There's going to be equilibrium forces playing out. So I think this is something you need to put more weight on than you would have had historically, but I don't think this is a default scenario.
Lisa's talked a lot about this. You look at the Treasury, they've aggressively shortened duration. The Federal Reserve, under this leadership, is putting a priority on cutting interest rates, or at least a bias to reduce interest rates, even with inflation around 3. Now, that might not be fiscal dominance per se, but maybe the symptoms of it, the consequences are similar. There's some crossover here, which I think speaks to the gold trade, doesn't it? To some extent, at least.
Yeah, I think as long as the macro picture evolves in a way that, it sounds cynical to put it this way, but there's a proper cover for cutting rates from a macro perspective, markets might be concerned about what's really the motivation behind that and whether it's sure. As long as we have the proof of it, I think we're going to run with, we're not in a fiscal dominance world just yet. But I think it's going to depend on if we reach the point where it's really very hard to explain cutting rates just on the basis of the macro outlook, and it looks like we're deviating, then I think it's going to be. I don't think it's going to be continuous. I think there's going to be a discontinuity at that point if we get there.
Stay with us. More Bloomberg surveillance coming up after this. building on this historic story, Norman Roule, the former senior U.S. intelligence official, writing the following: the Middle East continues to pose many challenges, but the president's approach reshuffled the strategic deck, offering opportunities and leaving the U.S. the undisputed major power in the region. Norm joins us now for more. Norm, Witkoff, Kushner, the President of the United States. Norm, what made a difference here?
Well, we've got a president who spent the first 10 months of his administration developing a new policy for the Middle East, a policy that focused on constraining Iran's nuclear program, Iran's proxies, providing Israel with unalloyed support, but also building very strong relations with a variety of Arab partners, resetting relations with Saudi Arabia, the United Arab Emirates, but also maintaining strong relations with Qatar and ensuring strong relations with Turkey and Egypt. And together, this provided an architecture that enabled the Trump administration to speak with pretty much everyone that needed to be brought to the table, but also to provide pressure on all of those parties through those channels. And then he used unorthodox approaches, Mr. Witkoff and Mr. Kushner. And I have dealt with Mr. Kushner in the past, and he's a very sober and hardworking individual. And we've seen extraordinary results. We should not understate the tectonic nature of this moment.
Norm, was it the strategy behind this Trump team that really changed it? We spoke to Amos Hochstein on Friday, who was an individual that worked under Biden, and said this deal was on the table in January. What's changed in the 9 months?
Well, aspects of this deal were always going to be on the table. I mean, the idea that there would be a prisoner exchange, of a release of Palestinian prisoners, the release of hostages, that there would be some sort of a disarmament of Hamas, that was going to be true no matter what administration was going to be in power. But the idea that you would bring pressure upon the parties to make this happen, I don't think that was going to be achievable in the Biden administration, because of the nature of their relationship with the players in the region. And the Trump administration had a very different approach, and that approach made this happen. So we should be clear, the Biden administration's approach to the region was unlikely to achieve this result. And the Trump administration did this in 10 months.
Norm, when it comes to what comes next, there's going to be this unprecedented peace conference in Egypt. What do you expect that will come of that? Will we get more information on what phase 2 looks like when it comes to Gaza?
This is an extraordinary conference. In and of itself, this is unusual. 20 nations. The president of Indonesia is showing up. You've got 20 nations dealing with Mahmoud Abbas, who has not been to Israel in some time. You've got the prime minister of Egypt, who has been invited and may show up nonetheless at the end of this important holiday. If that happens, that would be the first time he has been in Egypt in quite a while. If the Israeli prime minister attends, that would be the first time he would be meeting with some of these countries. And remember, there are countries attending this that do not have relations with Israel. And this would be the Israeli prime minister attending with President Mahmoud Abbas, someone he has refused to recognize. So this would be an opportunity for Netanyahu and Abbas to, in essence, set the stage for that second effort, that second phase. Also for these countries to identify what support they're going to provide, and for the president to pull them together and start that process. And it is critical that this security, that this aid be put in place to provide the Palestinian people with the humanitarian and security architecture they need to restore their lives.
Norman, just to that point, you were talking about whether Bibi Netanyahu, the prime minister of Israel, will be going. His office said this morning, he thanked President Trump for the invitation, but said he won't be able to attend due to the beginning of the Jewish holiday this evening. So we'll see whether he eventually makes it there. But right now, it doesn't seem like it's the case. And I'm just wondering, if you parse this out, is this coalescing of powers in the region going to be helpful to bringing Israel back into the international fold? Or is Israel still the odd man out? Is it going to take a lot for them to regain some of their previous reputation?
Well, again, we'll see how long the conference lasts, and if at the end of the holidays the Prime Minister is able to attend, we need to see what the Prime Minister's politics are like if the hard right becomes a problem, which prevents him from participating as well, because he would be meeting with Abbas. He would have to make some concessions. He has stated no Palestinian Authority in the West Bank, so that's or in Gaza. That's going to be a problem. But we've got a situation where the Israelis are now not going to be responsible for security or some of the reconstitution of governance in Gaza. The Palestinians will be doing this. Will Hamas be responsible for the problems of Gaza or the Palestinian Authority? Or it's no longer Israel's responsibility. It's now a Palestinian issue and an international issue. So in essence, the blame shifts from it's an Israeli problem to an international problem. But again, we must get humanitarian aid, security aid, and rebuild the lives of the Palestinian people. So I think before we get to that political problem, this is a humanitarian and a security issue, and that's where the emphasis will remain at this point.
Norm, I wonder if there's a broader conclusion also, because we used to see that the alliance between Western nations used to be the United States, Europe, and a couple of others, maybe Japan. Now it seems to be really shifting to the Middle East. How much has this deal and the U.S.'s relationship with Saudi Arabia in particular really solidified that idea?
Well, you've seen several things. So first of all, this wouldn't have happened had the United States not worked with Egypt, Qatar, and even Turkey. Certainly that's true. However, there have been months of intensive diplomatic conversations with Saudi Arabia and the United Arab Emirates, and Saudi Arabia working with France and other countries that in essence created an architecture that also made this happen outside of the United States itself. And that Saudi Emirati and diplomatic pressure was itself a dynamic that cannot be ignored. So these capitals, these rising powers, are something that need to be recognized and worked with. And the Trump administration, to its credit, did exactly that over the last 10 months, and we're seeing the results. So ranging from the chip deals that the Trump administration is putting together, the energy discussions, and now we're seeing this in the Middle East. It's a very interesting and dynamic approach.
Stay with us. More Bloomberg surveillance coming up after this. Let's stick with the data. Still impacted by the government shutdown. Abigail Watt of UBS writing the following. If the government reopens early in the week, it's possible that we may receive the September employment situation within 2 or 3 business days. Abigail joins us now for more. Abigail, if we don't, we could have this really strange situation at the end of the month where the Federal Reserve has the CPI report but doesn't have payrolls, has CPI about 3% and still decides to cut interest rates. How uncomfortable might that moment be?
Morning. Thanks for having me join. Look, I think you're totally right to focus in on the kind of balance between the labour market and the inflation data. I think that's clearly what drove the cut in the September meeting, was this shift towards concerns over the labour market. And while we might not get the September employment report, as you say, the FOMC are expected to get the September CPI data later this month, which I think will be helpful for them in understanding kind of potentially where that balance of risks is. I would say that even though we don't have the September employment report, we do have kind of other data that we can look at to get a sense of the state of the labour market. And in particular, we've been looking very closely at what we're seeing in the initial and continuing claims data. These data are not being published, in the normal kind of formal report from the Department of Labour, but we are able to kind of patch together the kind of state level data, and you're continuing to see kind of elevated levels of continuing claims in those data as well versus this point last year. So I do think that kind of balance between the two, the labour market data and the inflation side will keep the Fed on track to kind of cut at the meeting at the end of the month.
Abigail, what initially kicked off the sense that the Fed might be behind the curve and needed to catch up by cutting rates was the revisions to the payrolls that really came in so much more significantly than people expected. But Sunal Desai was on the show last week, and she said, actually, what it means is that the economy was doing pretty well without all of those jobs and without that job creation. Doesn't that speak to a wave of productivity, not necessarily to a real weakness? I mean, how do you sort of square these ideas that maybe we are just operating with a lower job creation base?
Yeah, look, I think obviously there's been, a wealth of people kind of coming out with estimates of what the run rate of kind of payrolls or the run rate of employment growth might look like, particularly obviously given the shifts we're seeing in terms of potentially population growth, but also kind of what we're seeing in terms of changes in participation rates. I think we've seen obviously participation kind of coming off a little bit, and I think that's probably likely driven by cyclicality rather than, say, kind of demographics, which has been the kind of downdrift that we've seen there in kind of recent years. I think the question in terms of the kind of run rate and kind of the tying together of what we're seeing in terms of growth in the labour market, I think really what you've seen is a step down just in terms of demand within the labour market. I do think it's potentially more demand driven than it is supply driven at this juncture, and I think one of the things we have seen is obviously a lot of noise in terms of the growth numbers with swings from kind of noisy components, but you have seen a step down in terms of the pace of domestic demand. That underlying pace of demand in the US economy was relatively soft through the first half of this year versus where it was last year. So I do think the kind of slowdown you've seen in the labour market and the slowdown you've seen in kind of the broader economy are kind of broadly consistent with one another.
How do you square that with Delta? And I know that this is sort of not a perfect data set, but it's the data set that we have. Delta reported earnings and it was better than expected. And they said they see no reason for there to be any softness in the path ahead. They're seeing demand really pick up across the board. How do you square that with the decelerating in labor demand that you just talked about?
Yeah, look, I think there's a potential reason for that could be that we are seeing a narrowing, I think, in terms of the drivers of consumption, right? So one of the things that we've been referencing for a while is that we'd expected that the lower end of the income spectrum would become under more pressure through the beginning of this year. And I do think we have seen that. I think one of the things we have seen, though, is that the upper income groups are continuing to sit on relatively healthy balance sheets. And there's a number of elements that we're seeing in terms of the income data, particularly the NIPA revisions, with a big kind of revision in terms of dividend income, supporting income growth in recent years. And I think that's also unlikely to be equally distributed across the income distribution. So if you think about kind of where the kind of support for kind of recreational services is coming from, it's likely to be coming from those upper income groups disproportionately. So I think that's the reason why, we have a slowing in terms of the economy. We have a slowing in terms of consumption, given the potential for kind of pass-through of tariff headwinds later this year. But we don't have an outright contraction. And I do think it is because you do have that kind of stronger upper income group in particular still kind of able to support, the pace of consumption as we go forward.
Abigail, when it comes to tariffs, how are you thinking about the latest rhetoric we have when it comes to Beijing and Washington and potentially an increased tariff rate on China?
Yeah, look, I mean, China is the area where we have seen, obviously, the strongest kind of ratcheting up of tariffs. They're sitting with the highest weighted average tariff of kind of any country and trading partner that the US has. And I think, the kind of resurgence of the rhetoric around potential for the 100% tariff to be added late last week. I think this is just a timely reminder that this is an area where we could continue to see tensions kind of flaring up. Obviously, we had the kind of November 10th deadline already in the calendar for the potential for the reciprocal rate on China to increase. I think, the kind of deadline here for the 100% of November 1st potentially gives you a little bit more time to see kind of more progress in negotiations between the two. So I think for now, we're watching to see how that progresses. I think obviously the experience of earlier this year, we saw a very strong kind of increase in terms of tariffs on China that proved relatively short-lived. So we would be watching to see kind of how that rhetoric develops in terms of before we would want to kind of think about how that might feed into kind of the economic outlook and our expectations.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.